We now continue with the Franchisee and Corporate tabs. When dealing with the model holistically, the Franchisee tab is intended to model the average franchise. However, the Franchisee tab can be used in isolation to calculate the economics of a single franchise with a unique cost or revenue structure. Like the Calculations tab, there are no directly editable cells on this page. We model the franchise over a 10-year period, indicated by line 11. The utilization rate is taken from the inputs page and multiplied by the total capacity of the school, in this case 24 students, to get the average number of students we would expect a franchise to have in the first year, in this case 12. This number is in turn multiplied by the revenue per student to get a revenue figure for that year. The revenue figure is fed into an income statement. We have line items which aggregate the fixed expense, variable expense, and the franchise fee that will be paid to corporate on the next lines. If the franchise operates at a loss, this will be included in the carried loss and credited for the next year until the franchise turns a profit and can begin using the carried loss as a credit against taxes. Lastly, we take the free cash flows of the franchisee and discount them at the discount rate entered on the Inputs tab. This is in turn used to calculate the NPV of the project assuming that the owner is also the principal and will be receiving the principal's salary, the ROI, a break-even year, and the amount required by the potential franchisee in order to start the new business. The cash flows from the Franchisee tab are the main inputs into the Corporate tab. We begin with a running tally over the course of 10 years of the number of corporate-owned centers and the number of franchisee centers that will be open. We next use a matrix structure to calculate the cash flows from the various franchises opened in the various years. For example, we can see here that in year 1, we will have just shy of 700,000 Rand in revenue from the corporate-owned centers started in year 1. In year 2, we will have about 931,000 Rand from those centers, as well as just over 1 million Rand from the new centers opened in year 2. We next calculate the startup revenue fees that are charged to the new franchisees, as well as the operating revenues from franchises opened in the various years using the same matrix format. The franchise royalty fee is charged only off of the operating revenues and not the startup fees. The same structure is used for costs, and lastly, these numbers are summed to get total cash flows from operations over the various years. The model includes the option to include debt financing. In this case, we model a 1 million Rand loan at an interest rate of 12% over a period of 10 years. The model is built for a mortgage-style payment, in that each year the payments are the same. The income statement combines the previous elements to calculate the net income in each year. For valuation purposes, we take the cash flows and discount them at the corporate discount rate entered on the inputs page to get an NPV, an ROI, and an estimate of the break-even year. Considering that Grow Commercial will likely have to raise equity financing, we calculate the amount of equity that would need to be sold in order for Grow to raise that amount of capital at its current valuation. In this example, we see that Grow would need to sell about 49% of the equity in the new venture in order to raise the amount of capital required to begin it. Lastly, we calculate the total cash flow to Grow Social, including the licensing fee, as well as the payment from equity. This number is used to calculate an estimate of the ratio of the number of grow commercial schools that will support one grow social school.